one of the interesting solutions that I've come across is a company called Rome. They do a really good job of surfacing the availability of assumable mortgages. A lot of people don't realize that you can still assume mortgages. So instead of just buying the property, you can actually kind of take over the payments of the mortgage, and usually there's some sort of transaction of like additional cash so that the seller gets the total price that they want for their property. And so like FHA loans and even VA loans, people can assume them. There's obviously like a complicated or a very specific process to that assumption process. And this is where I think they really shine, because a lot of agents aren't familiar with the assumable process. Same with many lenders, and or they don't want to go through the assumable process. It's a little bit less revenue for them, and they may not have the systems or protocols really put in place, as this is not a common transaction. So partnering with Rome, then you have someone who actually can take you through the process really at a little bit of a lesser headache way to do that. And it's an interesting application of tech to help people acquire homes at a more affordable rate. And if you think about it, you're talking about people can today go buy a house that has a 3.5% interest rate locked in, and yeah, they might pay a little bit of a higher price, but in comparison, that price at the average going mortgage rate today of like 7+% is going to be a significantly lower cost to the buyer at that stage. So it's a really interesting product to bring into the market. Another one that I think is pretty novel, and I'm interested to see how well it takes off, is a company called Onify. They're bringing a different approach to co-buying than I've seen in the past. There's a handful of ways you can do co-buying, and co-buying in of itself is not anything new at all. There's the idea of like a bunch of friends getting together and buying something, or maybe a non-married couple gets together and buys something. In some instances, you'll have someone buy their first home and they have their parents alongside them. And usually in those situations, there's a few other steps to go through. You really need to iron out how does one party get out of the property. The contract pieces to that is pretty important, especially for the mortgage company. They want to know that the asset really is going to be protected and covered, and someone's going to pay. Onify's approach to this is they have pulled together a pool of accredited investors, and they've created a fund. That fund then is used to do the bulk majority of buying a property. And what they do is buyers come along and say, hey, I would like to buy a house, but I don't have a lot of money to put down on a house. So through Onify, they can put down as little as 2% to buy a house in partnership with the fund of investors. So an individual LLC is created on every new property, and the fund of investors and the buyer then can go in and buy the house together. All the contract terms and all the stipulations are already preset. On a monthly basis, then the buyer, the homeowner occupant, is then actually acquiring more equity on a monthly basis. Onify uses a third-party AVM to adjust the value of shares on a monthly basis. And so then the homeowner is slowly acquiring more and more equity until they get to a point where they can actually then go ahead and refinance or get a mortgage on their own, which would then allow the fund to go ahead and exit the deal. So I think these are some really interesting applications of taking technology and approaching the home affordability challenges that many first-time and even second-time home buyers are facing with trying to buy a home in their local market.
Yeah, that's so good. I think one frustration being in the lending side of things is we get a lot of times these changes or these guideline enhancements or these programs, but they end up being more of a political statement than an actual tool that we can use, whether it's specific down payment assistance or first-time homebuyer programs. They either limit income restrictions, or the qualification window is so small that the pool of people who can actually leverage this tool, it's almost non-existent. And so you get a lot of tire spinning and not a lot of actual help when it comes to people who are just trying to figure out how to buy a house. So I think it's exciting that there's this, I don't know if private money or this investment window or this property, the PropTech space is there, seeing that there's a huge opportunity to kind of step in and help people just leveraging tools and technology and kind of the existing thing that's there. Question about the Onify or Ownerify?
Onify.
Onify. Are they, so at the time, are they leveraging the property value? Let's say it's a 5-year. Do they have a time window, or is it an equity window that they're trying to? exit? Do you know?
Yeah, so the idea is fixed payments for 5 years, and so that'll get them
Okay.
to a position where they would be able to exit through a refinance.
And so are they projecting future property value, or is it based on the value at the time? Do you know?
Yeah, so I mean, there's a little bit of math here. They want to get the homeowner to 10% equity, so they're charting a path to how do you get to 10% equity. Obviously, you can look into a crystal ball and do the best you can on what a 5-year
Sure.
window looks like. If the market has a significant upswing in values, you could reach that percentage early, and the
Got it.
homeowner could choose to then, take over completely on their own sooner than later. At the same time, if you had for some reason a significant downturn, then in that case, I would think that Onify would be incentivized to work with the homeowner on how do we extend the length of this contract, because they're not going to be earning as much equity with
Sure.
just natural rate of inflation along with their monthly payments.
Yeah. I think two things. I think that's cool. I think also it speaks to the value of investing in real estate, that clearly there's value. If there's money, follow the money, right? If there's money willing to invest in real estate, it's clearly a good investment. Obviously, there's risk analysis that goes into all of this for them, and they want to do due diligence by their investors. But so just to clarify, they're using future value. So as a person using Ownerfi, you're leveraging the payments to pay down, existing loan, or it is a loan, I guess we'd call it a loan, the existing investment plus, in 5 years, you're going to use the value of the property at that time to get to that equity position.
Yeah, that's the 5
Cool.
years. 5 years out, ideally, you're already at 10% at least
Got it.
equity, and then you can refinance it into other mortgage products.
So the market's on your side. Yeah, that's great. That's awesome. Yeah, the Rome is make sure I'm saying that right.
Yeah, Rome is
the assumable mortgage.
Rome is the company that's creating a marketplace where you can search and find homes that have assumable mortgages.
Yeah, that's also great. I mean, because two things, right? Those interest rates will most likely never come again in our lifetime. I mean, it was hundreds of billions of dollars getting pumped into the mortgage industry. And so
Right.
to be able to actually grab that interest rate, because I think the challenge, I would say assumable mortgages are like Sasquatch. Like everybody thinks he kind of exists, or maybe they don't exist, and maybe only a few people have seen him. For all my Bigfoot people out there. But to actually pull it off is really, really difficult. So it seems like this thing that's great, and it's difficult for a couple reasons. It's difficult because the servicer, right, the person that's currently holding that mortgage, they're not motivated to process all this paperwork to vet you as a buyer because there's no financial incentive for them.
Yeah, so
Right.
I'll
So
give you an example of one of the homes on their marketplace I'm looking at right now, which is in Colorado. You can put 88,000 down. So this is certainly going to favor those who have a larger down payment. It's a $600,000 house.
correct.
You put $88,000 down. So you're not 20% down, but you're more than 10% down. This would get you a 2.75%
Right.
interest rate.
Right. Yeah. So if you can overcome, right, biggest challenges are unmotivated servicers and then the down payment, but that's always, down payment's always going to be an issue. I think so. Rome is stepping in and saying, "Hey, look, we're going to work with a servicer for a fee to kind of take that off of your plate." But if you think about it, I think one thing that is exciting about assumable mortgages is that not only do you take on the rate, but you take on the term. So if it's a 30-year mortgage and there's
28 years left on it, so it's not
Yeah.
a full 30-year mortgage.
Right. So you're taking on the term, and what that means on an amortization schedule, right, is you're already, not only do you have the lower rate, which obviously is a win, but now you're further down that amortization schedule, more and more of your payments will be applied to principal. So totally a win, but they're definitely the unicorn of the mortgage industry for sure. So good to see that people are trying to help kind of take over that space.
Yeah, I think that one of the interesting things though is that, and I'll have to look up the stat here, but there's actually more assumable mortgages available on the market than a lot of people would probably guess. My assumption going into my discussion with the founder and CEO would have been less than 5 or 10%. And there's a fair amount more than that. So it's pretty common. It's just that sellers aren't aware that this is an option. So they could ask 10, 20% more on their house if they accurately market that it's an assumable mortgage.
Right.
And
And that's a good point. I mean,
agents aren't
right.
necessarily well versed in this, and so then these questions aren't even being asked, and they're not being asked because they're not being used to market the properties. And so if they were known, you would see this in listing descriptions more often. Assumable mortgage with 28 years left on term at a 2.75% interest rate. And you don't see that very commonly. So there's a significant awareness issue, and then being able to make that discoverable. So they're kind of solving a handful of problems here of finding the properties that are for sale with assumable mortgages, making them searchable, and then assisting in the processing.
Yeah. And if you leverage Rome services, are you still able to work with your real estate agent, or are they brokering deals too? Do you know that part?
Exactly.
Great. Yeah, I think I think on the surface, people see time as a challenge. So a lot of times sellers might not have the time to deal with the assumable mortgage. It takes time. I had a client, I guess they were more of I had an acquaintance that went through this process, and they were just kind of keeping me posted. And it was a 3-month process. It was a 3-month process, and the challenge for them was also coming up with the difference, right? I think that's the other misconception, is that you can just take on the mortgage. Well, you have to come up with the difference between the mortgage and the purchase price. They were having challenge there because the servicer wasn't willing to take specific second liens. They wanted the second lien to also be assumable, which I don't actually think that is the case. That's kind of one of the first times I've heard that. Typically, you can still get the second lien. And I think the other challenge is, other than just time, I think is sellers understanding, hey, look, if I'm willing to take longer to sell my home and go through this process, like you said, right, I can get 10, 15% more. And as long as the person can offset some of that cash difference, it shouldn't really be an issue other than inexperience. And so you get a company like Rome coming and saying, hey, look, we understand the process. We're going to navigate this for you, take a lot of the headache out of it. I think that's definitely a win.
Totally.
Sweet. Yeah. Assumable mortgages, they kind of, as rates spiked, they definitely came back into the conversation.
As they should be, but no one's talking about it.
It's just, there's so much different. I think, like a lot of things, like it's so much different than the 70s, and I think that's maybe where...
I want to find the number that's assumable.
The number, of homes. Yeah, I mean, you look at the 70s, and everything was assumable, even conventional loans, and very little paperwork, and...
Well, so according to Rome, any government mortgage, so FHA, VA, and it should be FH...
and USDA.
USDA.
Yeah, so you got your alphabet soup loans, Yep.
Okay.
Yeah, so USDA is going to be more strict on income requirements and qualification, but still assumable. And so that's the other piece people have to understand. You just have to qualify for the specific loan type. VA loans don't have to be assumed.
1/3 of mortgages
1/3 of all
2020 and 2021
yeah.
are assumable. They were government-backed loans,
Yep.
meaning that they can be assumed. And those are fully regulated.
Yeah, I believe it. That makes sense.
Loans.
Yeah. Yes, you've got your VA, which you don't have to be a veteran to assume a VA loan.
Right.
A veteran
it just temporarily
essentially
suspends the VA's benefit until the loan balance is paid.
Yeah, loan is paid. Yeah, so if they liquidate the property, there's other equations that the veterans can use, to get another VA loan. There's something called bonus entitlement, but it's pretty convoluted. But I think FHA is probably the most common. The only downside you could say is potentially, hey, if I'm assuming a lower rate mortgage FHA loan, is you're going to be stuck with that PMI, because that's always kind of there with FHA.
$50 in PMI with a 4% lower interest rate.
Yeah, 100%. Right. Yeah, the trade-off is still there. You're like, that's like maybe the one downside. You're like, yeah, but no.
The return on
the
return on that purchase is absurd.
Yeah. I think really, it'd be interesting to see a combination of the two. It's like, who's our assumable rate assistant that's also helping with the equity position? So you need to get your two people together. You need to get Onify and Rome together and help people bridge the gap between what the property's worth and where the assumable rate mortgage is. Then the investors, look at this, boom, free knowledge. Investors don't have to foot the whole bill. They're only footing a portion of it. They might not want to be in second lien
I
position.
think we can do, let's see here. No coming soon. Let's do, no, don't save search. How do I reset all filters? Okay. Keyword, assumable. There is one property in all of Whatcom County for sale with the term assumable in its listing.
In the listing description.
Let's see here. How do they use assumable? Yes, assumable loan at 6.125%. And it's a Lummi Island.
Oh, dang. They got that 6.125.
So
I get you that right now.
This just drives home the point here, right? So you have in a market where, according to Zillow, for all property types, how do I see how many?
So are they scraping
there's
recorded?
So I don't even know how many it comes out to, but you have 7 pages of properties for sale on Zillow, and literally only one mentions that it's an assumable mortgage. I'm willing to bet that is a telltale sign. Agents are literally not asking the sellers how did they finance the home to discover if it's an assumable mortgage, and that's because agents do not know that assumable mortgages could dramatically increase the marketability of a property. Yes, you might have a longer process, you might have more hoops to jump through, but ultimately, at the end of the day, the win for the seller is sell for a higher price, and the win for the buyer is have a lower cost basis. This is,
right.
You might have a little bit more work to do, but the wins make sense here.
Yeah. I think one real life example that I had was, and granted it might not be a good fit if it's a multiple offer situation, but the home had an assumable loan, and the realtor said, well, how do I know that this buyer, right? Like, how do I, it was along the lines of like the pre-approval, right? How do I know this buyer can actually qualify for the assumption? And so it was, because that's a conversation to have with the servicer. So it created this delay, right?
Yeah, you're going to be underwritten the exact same way. So if you're getting underwritten to buy a $600,000 home, and put it this way, the pre-approval is looking at the cost of the home, like the price of the home, and your monthly cost basis. And so that's going to be assuming, in a different case here, that you're probably going to get, let's say you do some point buy down and you're at a 6.5% on a good day right now. So if you got approved for a $600,000 home at 6.5%, and then suddenly you find a $600,000 home at 4%, I'm fairly certain the deal goes through.
Sure. Yeah, I think it was more or less around having the confidence to approach the seller and say, hey, look, I think it wasn't necessarily the buyer, but it was like, well, it was, but it was also the servicer. Like, hey, how do we have confidence that the servicer can get this done? Which, coming full circle, when you have a partner in that process, enter Rome, like it helps kind of bridge that gap, right? Where it's like,
exactly, yeah.
Oh, if that's not the headache, then okay, maybe this is simpler, and maybe that means $50,000 more for your seller. Like there's definitely a win there. I don't know. I don't know. Right. And they're not, and they're just simply basically navigating the process for you, right? They don't really have a hand in the actual finance. They wouldn't really have a hand in not the mortgage company. No, nothing like that. Yeah. They're just helping you through that process.
Yeah, they
cool. Yeah, they need to get a second lien. They need to get a second lien product. Are they working on it?
They discover and then surface properties to be searched and found, and then they assist with the process.
How are they finding properties? Are they going publicly available data and then just scraping it against
kind of
what's listed?
I mean, this is like part of the
That's the secret
challenge.
sauce.
It's not really a secret sauce. I mean, there's probably some combination of like scraping, using third-party data tools. You can find
Yeah.
in some areas, some mortgage information is more readily available and accessible than in others. So there's a myriad of ways to do it. They are going market by market. I'm sure there's some sort of like lender requirements, and it's a financial product, so it's heavily regulated. So they can't just anyone just come on by and work in this area. So it's got a fair amount of that to it, but it's not a
Yeah.
straightforward and easy process. Like I said, like I just there's 150 results on the page I'm looking at right now for one small map in part of a county, and one
Right.
property had the word assumable in its listing description.
Yeah, that's crazy. All right, shifting gears. I think one thing that we find, in addition to what I was saying, right? A lot of times we get changes to guidelines, or we get new things rolled out. Some for better, some for worse. I would think some of the for worse things have been around smaller investors and people trying to buy second homes. Under the guise of trying to help first-time home buyers, you've seen conventional Fannie and Freddie roll out what we call LLPAs, loan level price adjustments, in massive penalties for anybody trying to buy a second home or investment property. And they do this under the guise of trying to help first-time home buyers, and so everybody else is essentially going to get penalized, have a significantly higher rate than if you were just going to live in the home. You've seen that. We saw the loan level price adjustments, or these risk adjustments, change under the guise of helping lower income, lower credit score borrowers with smaller down payments. And so we shifted all of these adjustments to people with lower credit scores, lower down payments, who most likely won't get approved for these loans, but yet if they happen to, they would now be paying less than people with higher credit scores and more down payment. And so you see these really sad attempts. And I think ultimately with the government involved, things move slow or they move in a weird direction. And so when you see the tech space move into housing, what do you see that they get wrong? What do you see, and what do you see maybe in the future, like big areas of opportunity?
One of the challenges is that oftentimes from the outside looking in, and this can be on transactions, this can be on lending, this can be on renting and management, is there's a lot of, why doesn't someone do X? It's so obvious. It should be easier.
Right.
And that's usually coming from a lens of lacking firsthand experience in either going through a transaction, like leading the transaction, or playing a significant role, understanding the multiple parties that are involved, understanding that there's cooperative yet competitive nature to the business, and so that approach, while I think is good, it's good to ask those questions. It's not really digging into understanding why are people doing what they're doing. They're saying, why doesn't someone just do? And there was a recent TikTok that went viral of this guy who goes by the name of Older Millennial, and he's quite annoying, quite frankly. But he said, here's the billion idea for all you VCs out there. Why don't you just build an app that walks people through the transaction? Like, I don't want to go through the offer and inspection process and all this back and forth. It should just be simple. Like, put in the price you want to pay for it, and then just walk me through the transaction. And that's really fine and dandy, and I love the idea, and it seems like it would be really good. The problem is there's so much nuance and detail to every transaction that
Sure, 100%.
In order to execute that, you would severely limit the availability of inventory on that one location. Furthermore, now you have different rules to different localities because we have layers to how industries are regulated. And so there's state by state, there's county by county, there are specifics by county,
Right.
such as like water rights or mineral rights and things that get worked into contracts that you think don't really matter, but they actually have like a significant bearing on whether or not transactions can go through. So on the surface, it seems logical. It should just be as easy as buying a car. Buying a car is pretty dang
Right.
straightforward. Like, it's not nearly as
If
complicated.
you got 8 hours of your life to give away.
So
Right.
right. And so I think that there's sometimes an oversimplification of what the challenge is, and
Sure.
perhaps even a lack of respect for what the challenge is that should be an obvious solution.
Sure.
On the
You're making
other
me feel
side of the
good about
coin,
my job security. Yeah.
on the other side of the coin, though, I think there are sometimes it's an overcomplication. Like, and I'll pick on blockchain for a minute. Like, I have really worked to understand blockchain and crypto transactions as to how they relate with real estate, and it's stupid. Is the only way I'm going to put it. There's all these extra steps and complications, and it's fine if you want to manage, the back end of your business on some sort of chain. Congratulations. But the reality is the end consumer doesn't need to hear about it, know about it. It doesn't need to be the central point of communications. I don't want to have to set up a digital wallet with some third-party website and have tokenized access to this, that, and the, these are all the things that this is just adding more friction. And in fact,
Right.
if you think that that's going to create a user interface where I, quote, don't have to use an agent, quote, I actually believe it's going to cause the inverse action. It's going to cause consumers to seek out the agent, because having to figure all that stuff out on your own isn't realistic. There's a lot of other challenges when you're trying to do, I think there's been some push towards the instant transaction. And I happen to be of the belief that some friction is actually good in the buying process, and minimizing or totally reducing all friction is actually harmful to the consumer. Even if we get inventory online, the ability to execute transactions quicker today is already there dramatically. Just the fact that digital signatures speeds the process, the ability to compare properties speeds the process, the ability to get loan approval same day, same hour speeds the process. Banks offering and guaranteeing on 30-day close speeds the process. So all these things expedite the process, which then that just increases the competition for the inventory. So you put all that in place, it actually then that's what then pushes and drives price. Price is driven by competition for the same limited good that's available. I don't think removing all the friction is actually going to be beneficial to the average consumer. To some people, it may be beneficial, and these would be people
That's a good point.
or companies that may function like cash buys. Cash buys have some sort of, for some sellers, they represent more value because they can close faster. They can execute quicker. And you hear the complaints of like, oh, I lost to a cash buyer, this, that, and the other. Well, yeah, reasonably so. Because mentally, cash sounds better than someone who has to get a loan. You'd think that there's extra value. If you could just wait 2 weeks, you could probably get more out of it. So I do think that there are some companies that are overcomplicating their
Right.
approach to the industry and think that consumers really want some super high tech, or they want all these buzzwords and this, that, and
Yeah.
the other. And I think that the reality at the end of the day, they want to know and trust the transaction. And even if they've been to it 2 or 3 times in their life, you're talking about doing something 2 or 3 times in your life. Over the last 10
Right.
years, the landscape for finding a home and buying a home has significantly shifted. And so it's not going to be the same every time. It's going to have some variations. There's going to be differences in the market. Stuff has changed. Expectations has changed. The way things go through, some of that stuff has shifted and expedited, or it's changed in process. So I think it's really important that people understand, like, the role of agents still serve as like a pillar to most consumers. And the overcomplication of things, or making everything self-serve like a vending machine, may work in some instances, but I just don't think that that's really what the consumer's looking for.
Right. You know what you can't figure out from a vending machine?
No, I don't.
What a house smells like. Like, how many cats did they have in here, man? Because, it's like, that's the thing about shopping online. Like, you can't, how it feels, how it looks, how it, there's so many, I always say photographers are the heroes of the real estate industry, because a house looks great. And then you show up and you're like, is this even the same house? Like, what's going on here?
That's certainly something I learned as an agent, is that you can't change the first impression of how someone, like when they first walk in the door, the smell. So I remember getting called out hosting an open house, and someone walked in, and I had a fairly powerful air freshener hidden in the closet because the homeowners had dogs. They had large dogs, and it was pretty obvious that they had
Uh-huh.
large dogs. And so the person walked in and they said, "What are you trying to hide?" And that was kind of the light bulb moment for me of like, you can't change that impression on someone. That being said, where we live now, we bought
Right.
remotely. We put it under contract first, got the terms in place first, and I hedged my bet that what we saw was accurate and good. I also talked to my realtor, and we did FaceTime walkthroughs, and so I had him FaceTiming with me, walking through, and I was like, "Hey, what's it smell like?" And I actually asked him that in every house. I
You asked
might
him
be a
that?
little
That's
bit
so good.
different as a
This is
buyer to be saying like, I need you to tell me what it smells like, because that's a detail that I'm very familiar with, and especially if it's embedded in the
yeah.
carpet. We're not talking about a shampoo job here. We're talking about recarpeting. And I knew
Right.
that
New
the house we
flooring.
bought,
Yeah.
they had dogs. There was no strong odor of dogs, but one of the very first things that I knew I was going to be doing was having all of our HVAC vacuumed out and cleaned out. So we got rid of that pet dander and whatever else that was
Yeah.
in our HVAC. So we weren't breathing in what the owners essentially had left behind.
Yeah. Yeah. I'm going to pick your brain a little bit. What do you see? Because I think it's such an interesting concept because it's something as somebody in the industry, I'm always looking ahead like, okay, do I need to shift? Are things going to shift? And I guess, especially with the conversation around AI and it's kind of exploding, are people becoming like, is this something that's obsolete? And this tension between, okay, we understand, I think as humans, like we value that, right? And that's this conversation. Like there's value in kind of the way things are done and they've held through the test of time, right? I saw a great post from a realtor. I wish I had it, but it was like, in 2000, when the internet came along, we thought we were going to be gone. Right there, she listed out. She's like, I've been doing this 40 years. They were going to replace us 5 times, and we're still doing it. She's like, just get out there and take good care of clients. I was like, yes, that's awesome. But in that conversation where there's this, like the current solutions, there are a few that are great fits, but there's also, right, you talk to everybody. There's a few that are clearly trying to simplify, but at the same time overcomplicating the process. Maybe they don't quite understand it. Maybe it's lack of experience of what consumers actually want, and they're like, we fix things by making it easy through technology. And you're like, okay, but that's actually not maybe where the problem is. And I think on the flip side, you've got kind of the rigid structural processes that we operate in that are guidelines and investors who go to the market, right? And they are pulling, and what people may not know this, they're pulling from your 401ks, right? That all of that money is invested into the housing market. That's where your loan comes from. And so there's due diligence and what we call the ability to repay that we have to go through that say, hey, look, if you're going to borrow money that literally our entire financial system evolves around, right? Well, you have to be able to pay this back. And you compare that against, okay, pre-2008, where it was like if you had a pulse, you got a loan. Is there, what I always ask, I'm like, is there a balance? Like, is there somewhere in between where we're still limiting risk, we're leveraging technology. This is a big question. We're leveraging technology, but we're actually making the process work. Like, I just feel like it's working, but it's not working great. Maybe that's an inventory problem. Maybe we're asking the wrong question. Maybe it's an inventory problem. But just kind of when you're out there in that space, in the tech space, do you see that there's something that excites you as a potential solution? Or you're like, hey, look, this is just kind of how things are always done. As human beings, it's a very, kind of what you're saying, like it's a very unique process. Every transaction is different. And you look at every transaction that happens in America. But do you foresee where this, like a solution and kind of see where things are going, or is it just like, I don't know. Do you get what I'm asking you? Do you kind of see? It's a big question, but
I have a handful of thoughts here. I think from like the agent side, and even from the lender side, being known for something and being a master of your craft is far more powerful than any fancy CRM or any sort of like really flashy website and whatever. It doesn't matter. Now you can be known through your social media. You can be known through your local backgammon club. You can be known because you're the canvasser. I don't care. but be known for something. People have to know and for a reason to call you. I think really digging deep into that is something that often gets missed. This is why the average agent barely makes a living wage. If we look at the numbers, it's something like 60 or 70 grand a year is a 1099. That's pretty rough.
Oh, dude, I think it's less. I think it's like 25.
So, and they're doing less
or
than
40
one deal
maybe
a month. And so if you look at the agents that are above average, you'll notice that they usually have something they're known for. They know the area better than everyone else. They're very skilled in multifamily. Or they know the investors. They know how to handle VA loans, and they pride themselves on that segment. There's lots of different ways in which you can cut it up and dice up what you're known for. And I think that that's more important. The next step, and something that I learned in my time at Ben Kinney, was systems. Your systems need to be down pat. They need to be articulable. They need to be demonstratable. And you need to be able to execute your systems. This is regardless of technology. So if you just had the best assistant in the world and you knew every single step to every listing, you could execute. But you can also now get better at that as you learn a little bit of, okay, well, we can use this tool that helps automate this, and this with maybe our social media and emailing out to the database and doing regular touches throughout the year to farm our core circle. Those are things where you get additional leverage in your on your database and your marketing and sales efforts.
Right.
And then the last piece here is like, once you've become a master of your craft and you become known for something, you have your systems. Again, they're something that you can articulate, you can demonstrate, and you can execute against. I think the last bit is use some time for retooling and training on a continued basis. I think oftentimes people put on blinders and just head down. And by the time they look up, they realize how much has changed around them. Kind of reminds me of a realtor I worked with in Chicago. Her headshot had not been updated since the early 70s. And I know that because it was still black and white.
Never happens.
Yes, exactly. And so, these are some of the things that I think you still have to retool. You still have to get into learning the new regulations. You have to go back to contracts, education. You have to still stay up on, hey, look, these are some of the things that you can use in your business today. This is how you can enhance your photos. This is what good photography looks like. This is how to help the photographer. Even just that alone, like get crap out of the house. Why? Well, because a photo with a lot of crap in the house versus a photo with not a lot of crap in the house, they're not comparable. Video has become far more important. Just the idea of where do you even find a drone operator to be able to take good drone shots, especially of maybe a larger property or a property with a view. It doesn't seem like those aren't very high-tech things here. And they're somewhat peripheral to the transaction. They're somewhat peripheral to the service, but they're also directly related and interconnected. And so you have to continually learn and educate yourself. So when it comes to things like enhanced tools or AI and stuff like that, allocating some time to understand, hey, what is this? Is there an application to my business? How does this fit into my systems? How does this make my systems better or power them? I think those are really the approaches to take.
Yep.
A lot of times people look at the features and they say, what can I use this for? As like a reason to use the tool. And I think that process thinking is backwards. It really should be, how does this fit in with my system? How does this make my system better or faster or more convenient to my customer? And then we have an evaluation of the cost of value of the tool, applying it to your business. I think as long as that lens is taken, you'll really easily drop all the noise, because there's plenty of noise in the market at the moment.
Yeah, that's so good. I like that. So yeah, master your craft, embrace tools and technology as they come. Don't be afraid they're going to replace you, and never stop learning. I think the one thing, the key takeaway is solving whatever issues we have in real estate is very complicated, and I don't think it's going to be done anytime soon. But what we do know works is what's happening now, and so leveraging that is so good. And I think the never stop learning piece is so good, because I think what we'll see with tools and tech is that we'll have access to more and better data, and it's going to be, how do you leverage that to continue to make yourself better and go out there and serve people really well.